Every country has government debt, but the amounts vary from a little to what most people cannot even imagine. The United States, for instance, has tens of trillions of dollars of government debt, and Japan and Europe are just as bad. This brings up a question that at first sounds very simple, but the more you think about it, the more it becomes confusing. If almost every government is in debt, then who are the ones that are getting paid? A lot of viral videos dramatize the answer to this question. According to them, the system was intentionally set up to keep governments in debt indefinitely. While that explanation sounds plausible, the truth is more complicated, and in many ways more fascinating. Government debt has never been like personal debt, and it is not working like that either. It was not designed to be paid off and closed like a loan on a house or a car. Rather, it has become one instrument among others in the evolving stock of modern economies. To understand why government debt never gets paid off, we have to look at how it came about and how each new solution to an old problem brought new consequences. In the past, governments took loans in a very simple manner. They required money, most of the time for wars, so they borrowed from merchants or nobles and promised to repay the loan with interest. If the government failed, it defaulted, the lenders lost money, and the debt was erased. This made borrowing unstable. Lenders were cautious, interest rates were high, and governments were always in a struggle to raise enough money when they needed it the most. When states became bigger and wars more expensive, the system could no longer work. By the end of the 17th century, governments had to find a more dependable way to finance themselves. The solution they took was a game changer. Instead of borrowing money with the expectation of repayment, governments started issuing long-term debt that paid interest continuously. The government debt thus became much safer for lenders and more manageable for governments. As long as the state existed and was collecting taxes, interest payments would continue. The intention was stability, not exploitation. However, the unintended side effect was permanent debt. Once debt was made permanent, it also became predictable, and predictability made it valuable. Government bonds were transformed into financial assets that could be held for income rather than repayment. These bonds gradually became tradable. They could be bought, sold, and used as collateral in transactions across borders. As a result, this created deep and liquid markets that allowed governments to borrow quickly and investors to move in and out freely. The advantage was flexibility and growth, but the downside was complexity. When debt was held by thousands of institutions across multiple countries, default ceased to be a simple refusal to pay. It became a systemic event that could destabilize entire financial networks. As economies grew larger, another problem arose. Financial crises became more frequent, and bank failures had the power to freeze entire economies overnight. To deal with this risk, central banks expanded their role. To stabilize the financial systems, central banks extended liquidity to the markets during crises, controlled interest rates, and purchased large quantities of government bonds. In essence, the way government borrowing functioned was dramatically altered. Before central banks, governments were constrained by the amount of money private investors were willing to lend. After central banks came into the picture, there was almost always a buyer ready to step in during a market sell-off. Debt could be continued rather than canceled, exchanged rather than paid off. Stability was the aim throughout. However, the outcome was a system in which debt hardly decreases and almost never disappears. By the late 20th century, government debt had gone worldwide. There was a time when numerous developing countries took on heavy debts, mostly in foreign currencies, with the expectation that their growth would be enough to pay for the cost. When interest rates increased and the economic situations deteriorated, those debts became unpayable. Default was only technically an option, but the ramifications would have been very serious. A considerable default could have endangered banks, the flow of trade, and the overall stability of the world's financial system. Instead of simply canceling debts, international institutions turned their focus on restructuring them. More loans were given, payments were rescheduled, and new terms were set in exchange for support. Debt was no longer being erased. It was being managed indefinitely. Currently, most of the government debt is in the hands of institutions rather than individuals. Pension funds, insurance companies, banks, and central banks are the holders of government bonds as they are regarded as safe and stable assets. Interest payments go from the taxpayers to these institutions as a part of the system's normal functioning. It is not a secret, and it is not a mistake. Government debt acts as financial infrastructure. It keeps safe assets available, encourages liquidity, and helps in the stabilization of markets. This is also the reason why debt cannot be simply paid off without any consequences. Getting rid of huge amounts of government debt would mean removing the base that many financial systems are built on. There would be less liquidity, markets would become unstable, and economic activity would slow down significantly. Government debt is not a scam, and it is not a secret plot. It is a trade, off, debt kept forever in exchange for stability. Interest payments made continuously in exchange for liquidity. Systems that are complicated in exchange for economic growth. The real risk is not debt itself. The real risk is not understanding how it works and thinking that it behaves like personal borrowing. This system is imperfect. It generates inequality and consolidates wealth across time. However, it is also the very system that keeps the contemporary world economy running. The question of the world is not to figure out who designed the system. The question of the world is whether we comprehend what it performs, why it exists, and how much it costs us to keep it. If this reasoning has allowed you to view government debt in another way, then it has done its job. And that's the moment the ledger outvotes the ideology. Chrono finance, following the money through time.